And now, Lifestyles Unlimited presents the Real Estate Investor Radio Show. Over the next hour, we unfold your map to financial freedom. You'll learn how to retire through investing in single-family and multifamily real estate. You'll learn how to create cash flow and build wealth so you can have the time and money to live the lifestyle you want.
Welcome to the show. My name is Al Gordon, and as always, I'm working on your financial freedom. And on today's show, we're just going to talk about all the headlines out there because I'm convinced the headlines regarding real estate is they're driving you nuts. They've got to be driving you nuts. They're driving me nuts. I'm looking at a list of different headlines, and depending on the article, I either get the impression that the housing market is doing extremely well or the housing market's about ready to collapse. Yeah, it's amazing to me how the press can go and look at the same thing and come up with two completely different conclusions to what is going on. Do you see that in the news? Can you turn on one news station and get a news story that's slanted one way and then change the channel and get another news story that's slanted a different way? Yeah, well, that's what I'm getting here as I look through all these different real estate-related articles. So what articles am I looking at? You're probably wondering. Al, just get to it, right? Okay. So Forbes, they have an article that came out 3 days ago. And the title of the article is simply Housing Market Predictions for 2023. When will prices be affordable again? Yeah, so they're talking about affordability. That article is talking about the fact that home prices are literally the highest that they have ever been, ever. Period. Ever. I mean, they're higher than they were 5 years ago. They're higher than they were 3 years ago. They're higher than they were a year ago. Home prices continue to rise. I mean, you know, we've got inflation going on, so maybe that's got something to do with it. But pricing is going up, according to Forbes. Now, check this out. Yahoo. Yeah, yahoo.com. You know Yahoo. Or is it Yahoo? Yahoo? I don't know. I'm probably going to get sued. I'm going to be nice. FinanceYahoo.com says 2023's housing correction could be the largest since post-World War II. They're indicating that the housing market in 2023 is now showing signs that there could be problems. Big problems on the horizon. They say prices are now so high that banks are losing money on mortgages. Interesting, isn't it? Banks are losing money on, or how do you lose money on a mortgage that's making you 7% or 6%, and the payer is paying? I don't understand that. I'm sure if I got deep into this article, I'd understand what they're talking about. But the gist there is be prepared. Housing prices are about ready to fall. So Forbes is saying highest prices ever. Yahoo's saying the prices, well, they could be going down. They could be problematically going down. I mean, they said largest correction since post-World War II. I wasn't even alive back then. I'm guessing you weren't even alive back then. Now, some of you listening to the show, you may have been alive post-World War II. And, man, I hope I have your longevity. I really do. But, man, post-World War II, I mean, we went through a pretty decent correction. I'll use the word correction back in 2008, you know, as a result of the government getting involved in the mortgage business and taking all the restrictions off of mortgages, making it so anybody could get a mortgage because in their mind's eye, they were thinking this will allow everybody to have the dream of owning a house, the American dream of owning a house. Even though it's not in the Constitution that you have a right to own real estate, well, technically, you do have the right to own real estate. It's technically protected by the Constitution, but it doesn't say specifically that you get to own your own house. I didn't read that in there anywhere. I'm serious about that. So in 2008, we saw housing prices decline. We saw an overall decline in the market of about 27%. And that decline occurred right after, well, it really started back in around 2007. And then when 2008 showed up, prices were already starting to come down. They declined overall 27% to the lowest they were in years in 2012. So from 2008 to 2012, what we experienced was a decline of about 27% in the value. Now, I will tell you, that was a time period that Lifestyles Unlimited members made a lot of money. I'm serious. They made a lot of money because what you're not familiar with is the fact that after 2012, housing prices, well, they got back on track. They got back on track. They started rising again. Now, they didn't always go upwards and to the right like you would like to see your stock chart do, but the trend line is going upwards and to the right. And it crested. Now, I'm looking at something called FRED. What is FRED? FRED is a economic data resource provided by the St. Louis Fed. And what I'm looking at is their S&P Chase Schiller U.S. National Home Price Index. This gives me an idea of what pricing is doing in the marketplace. And I'm using this to educate you on the fact that pricing went up. This is the part you're all wanting to hear. In June of 2022, pricing capped. Yeah, pricing hit the highest it has ever hit in the United States. But I know for a fact that prices were even lower prior to 1997 than they are now. It's just the reality of the graph I'm looking at. But in June of 2022, that price peaked. And since then, the pricing for homes has gone down about 5%. According to this graph that I'm looking at, pricing has gone down about 5%. So there are people out there that are licking their chops. There are people out there that are in the belief that maybe this is that time when we're going to make a lot of money again. You are conditioned to believe that when prices go down, that automatically translates to you into losing money. And the reason you believe that is because that's what actually happens to you when you invest in your stock accounts or your mutual funds. When the price of those funds go down, you effectively lose money, right? I mean, that's what you think. Now, to be honest with you, you're not really losing any money because when you bought the stock or when you bought the mutual fund, you locked in the pricing at that point. And then if you continue to buy shares of that stock, you continue to lock in pricing at whatever points you buy it at. Your financial advisor will tell you that when the stock prices are going down, this gives you a great opportunity to do something called dollar cost averaging. So what they're essentially saying is you're buying the stocks on sale, right? That's what they're telling you, and they're trying to get you to calm down while you wait for the market to recover. Okay, but how does that work in real estate? How does it work? Let's say you buy a house, and let's say the house is worth, let's use super easy math. You guys cool with super easy math? Because my brain isn't working that well today, so I need super easy math. You buy a house that's worth $100,000. Let's say the market adjusts. Let's say the price of that house goes down 5%, kind of like what I indicated in the last segment. That's kind of what the market's doing. So now, if you were to sell that house, the value of that house is $95,000. Would you lose money? And the short answer is, if you were to sell the house at $95,000 after you paid $100,000 for it, yes, you would realize a loss on your capital gain. You would effectively lose $5,000. But we don't do that. We don't do that. Listen to me. I'm serious. We don't do that. If I buy the house at $100,000 and the house goes down 5%, it goes down to a value of $95,000. I don't sell the house. I don't need to sell the house. I'm holding the house for a future event. I'm holding the house for when the values go up to a certain price point. When they achieve that certain price point, I have a decision to make. Do I refinance the property and take my money out tax-free, or do I sell the property and realize the long-term capital gains and take my money out that way? I don't sell the property because the property has gone down in value. That's not why I've bought the property. As a matter of fact, when I buy the property, I usually have a holding time anywhere from 1 to about 5 years, and it's dependent on the particular property. Now, when I gave you my assessment of the FRED, remember the FRED? Yeah, that's what they call it, the FRED. This is the What do they call this thing? The S&P Chase Shiller U.S. National Home Price Index. Oh my goodness. And it's now get this. It's got like a 10-letter acronym to describe this thing. I've never seen an acronym that long. And I was in the Army. We live on acronyms in the Army. I've never seen a 10-letter acronym, but there it is right in front of me. Okay, so the point I was trying to make was from the period of about 2007 to about 2012, we saw pricing go down about 27% across the board. We did. So if you bought a house in 2007 and you held it for 5 years until 2012 and you sold that asset, then you would have effectively lost 27% of your investment. But you shouldn't have done that. The key thing is this with real estate. You hold the real estate and you operate the real estate for as long as you need to so that you get the financial wherewithal out of the property. Does that make sense? So when would you have had to have waited? Okay, so if you had acquired the property, let's say in January of 2017, does that make sense? All right. By November of 2016, the prices would have come back on a national average. On a national average, the prices would have come back. And you're thinking, that's a long period of time, Al. That's longer than the 5 years you usually say that you need to hold the property. You are right. That is much longer. There's got to be a workaround, right? There's got to be a workaround. There's got to be a way that we can buy property, that we can protect ourselves from a 27% decline in pricing. Even if we buy at the top of the market, there's got to be a way we can buy this property, protect ourselves, and still do financially well. And there is. There absolutely is. See, most of you are looking at this exercise, this pricing exercise, from a retail pricing standpoint. You're looking at the asset from its retail pricing inputs. I'm not going to look at the asset from its retail pricing inputs. What I'm going to do is I'm going to look at the asset from a wholesale pricing input. What am I getting at? There is a way that you can buy real estate where you do something called capturing equity. Yeah, capturing equity. In other words, what you're doing is you're buying the asset at wholesale pricing. You're getting in at the ground floor. If the property is worth, let's say, $100,000, you're not going to pay $100,000 for the asset because you'd be paying full retail value. And here's the thing. I don't want you finding properties that are all pretty and all fixed up and ready to go. Because when you find properties like that, you're paying full retail pricing. You don't get the benefit of capturing equity. I want you to go out and find the dirty, nasty, ugly properties that are out there. The property where when you walk up to it, you kind of go, I don't think I could live here. Yeah, that's the kind of property I want you to find. I want it to be when you walk in, you kind of go, yeah, you're smelling, you're sniffing around, and you go, is that what I think it is? Is that the smell of cat urine in this property? Oh, that's a terrible, terrible smell. But I will tell you this, to a real estate investor, that is the smell of money. It is the smell of money because what you have come across is an asset that most people have no interest in buying. And the reason they have no interest in buying it, they don't know what to do with it. They don't know how to breathe new life back into it. They don't know how to make it a beautiful property that people will call home, that they'll be willing to pay 1/3, you heard me correctly, 1/3 of their disposable income to live in that particular property. They will spend 1/3 of their money to call that place home. Yet you're looking at this property and it looks like a tornado hit it. Yeah, and that's okay. Totally fine. We come back from the break. I'm going to get into the financials. We're going to talk about how you'll make money even if the pricing goes down. Stick around.
Got questions? Call Lifestyles Unlimited at 855-497-4335. The Real Estate Investor Radio Show continues next.
Lifestyles Unlimited members share their stories and strategies for success at case study events.
If you got laid off tomorrow, what would you do? Would you have to be working at McDonald's or wait to try and find another job with the downsizing the economy? Kept on coming to meetings. even with David Fisher online and stuff like that, but still, we just like, we need to make the jump.
So we kept praying for time to get this job done, to be able to find the properties. How do we find the properties? How do you find the time? And God answered our prayers, and he got downsized from his corporate job.
But they didn't buy just one house, right?
No, they did not. You're rehabbing house number
9 right now.
9.
Wow.
So every month, the cash flow is $3,200. Okay, the equity of all the houses is up to $280,000.
Join us this month and learn from people just like you. Check in person and online dates at lucasestudy.com. That's lucasestudy.com.
Creating the lifestyle you've always wanted. You're hearing Lifestyles Unlimited's Real Estate Investor Radio Show.
Welcome back to the second half of the Lifestyles Unlimited Real Estate Investor Radio Show. My name is Al Gordon, and I know you're just wondering if the statement that I made before we went to break is a valid statement. All right, so here's the statement. You can make money in an up market or a down market. I don't care if pricing is going up. I don't care if pricing is going down. When you're looking to put a new asset into your portfolio, you're not looking to trade an asset for another asset. You're looking to put a brand new asset into your portfolio. You need to do exactly what I'm going to tell you to do right now. Buy low, stay low. Okay, I'm getting at the fact that if a property is worth $100,000 in the marketplace, you should be buying that property for about $50,000 because it's going to take a certain amount of money to breathe new life back into that property. Remember, this property that you're buying, the reason you're able to get it for 50 cents on the dollar is because that's what it's really worth in the current marketplace. It's got issues. It's got problems. Now, think about normal things. Do things break? And the short answer is yes. Things wear out over time. Do you think the functional systems of a single-family house might wear out over time? Hot water heaters. I think the average age is around 10 years or so. How about the air conditioning and heating system? Well, if you buy a quality one, it might last 15, 20 years. It might even last longer. When you buy an asset, you want to go through that asset and you want to figure out exactly what is serviceable for at least the next 5 to 7 years and what is not. Now, you need to know what it costs to fix or replace these things, so you need to have in the back of your mind data that you can use to formulate repair costs. So when you take a look at this should be worth $100,000 property, only worth $50,000 in the current condition it's in, and when you consider that it's going to take maybe $20,000 to fix that property up, you're all in on that property at $70,000. Yeah, $50,000 to buy, $20,000 for repairs, plus you're going to have some closing and holding costs. The difference between all of those costs and that $100,000 is the equity that you will capture in this property. Now, if I told you the closing and holding costs were going to be around 10%, okay, that means $50,000 to buy, $20,000 to repair, closing and holding costs another $10,000. So now we're all in at $80,000, $80,000 to buy this house. But here's the thing. When you buy that house and you repair everything, and you put a great resident in that property who's going to live there, take care of the property, pay you rent, 1/3 of their income, they're going to pay you on the first of the month, every month, like clockwork, you're still going to capture $20,000 of equity in this property. $20,000 of equity in this property. So let's think this through. Let's say it's the top of the market. Let's say it is. And let's say we just bought this house for $100,000. And unbeknownst to us, I'm not saying this is going to happen now. I'm just saying that let's say we're going into a situation where property values might go down 27%. But you've already captured $20,000 of equity. That's free equity in the property. You didn't pay for that because you bought correctly. You earned it. You earned it. Now, if the property goes down 27%, you know that the property is going to be like in what? $73,000. It's going to be worth $73,000. But you're into that property only for $80,000. So technically, the equity position has insulated you for 20 of the 27%. Does that make sense to you? Okay, so you only really are dealing with a 7% decline. How long does it take to recover that 7% decline? I would suggest to you, based on what I'm looking at from the Fred graph that I mentioned to you at the beginning of the show, it's not going to take you 5 years to get back to that $80,000 price point, because the reality of it is this: even if the prices decline, and even if you're tapping into the money that you essentially put into the asset, your recovery period is much shorter, and you're not going to lose any money. That's very important. Whenever you buy an asset, you have to consider three things. The first thing is it must cash flow. It has to provide cash flow. And we're going to talk about that cash flow component in the next segment. But here's the other thing. You can't lose money, and you can't get rich slow. Those are Del Walmsley's 3 rules for real estate. And I will tell you, those 3 rules apply even in this situation. Even if we bought at the top of the market and the prices have declined so much that we're actually tapping into our own equity, we haven't sold the asset. We are waiting for the pricing to recover. And as we wait for that pricing to recover, we are taking advantage of the income streams that are produced by that property. Yeah, income streams that are produced by that property. Now, I will tell you, the average property that we buy at Lifestyles Unlimited, at least in the single family space, tends to produce about $400 a month in cash flow. Now, some assets produce more, other assets produce less, but we like to be in that $200 to $600 range. And that $400 spot, well, that's kind of optimal. And here's the thing. $400 a month in cash flow produces $4,800 of income per year. What's going on now? What is going on now? Well, there's a lot going on now. The government is still doing what the government does. The government may or may not do something that's going to affect the pricing in the housing markets. You've got one article saying that pricing is probably going to be as bad as it was post-World War II. And then I've got another article that says, hey, you know what? Prices haven't been higher ever. Yeah. So who do you believe? You have to believe the market. You have to understand the market. You have to read the market. You have to educate yourself on the market itself. So let's get back to this discussion of buying an asset and controlling equity in the asset. I think this is a very, very important piece of information. Now, Dwayne sent me a property that's located in Missouri, and this particular property can be bought for $122,000. Now, when you fix it all up, it's worth over $184,000 in the marketplace. What's interesting about this property is Devane said that I can buy it for under $30,000, and I can capture almost $27,000 in equity. What does that work out to be? That's about a 92% estimated return on the equity capture. What that means is I am almost doubling my money when I buy this asset and I repair it, and I do it all correctly. I do it the Lifestyles Unlimited way. I find a great person to live in the property, and then I put long-term financing on the property. And because I'm using a hard money asset in order to acquire and repair this property, it allows me not to put 20% down of my own money or even 25% down of my own money. It allows me to only put $29,000 into the deal and to capture almost $27,000 of additional equity. That's almost a doubling effect of the cash flow. What that allows the property to do for me, now this is kind of an insurance policy if you really think about it, because if the property does go down in value, you are insulated by the amount of equity that you captured in this asset, that it's not going to tap into the money that you actually put into the asset. You're playing on the house's money. Yeah, all you gamblers out there, you're playing on the house's money. Now, this just assumes that pricing is going to go down. But what if property prices don't go down? What if they stay constant? What if, oh my goodness, what if they actually go up? What if they go up? Now, think about this for a minute. A lot of the news that you've been reading, it's talking about the overall markets, right? The overall markets. And that includes all those properties out there that you shouldn't be buying as a real estate investor. What kind of properties are those? High-end homes, personal residence homes. Yeah, things that don't provide you a good cash-on-cash return because you're overpaying for it. Yeah, we don't buy that stuff. As a matter of fact, the stuff that we buy is stuff that's essentially in the entry level of the housing market. Yeah, the pricing that I'm telling you about, I mean, this particular property in Missouri, all fixed up $185,000. If you're listening to my voice and you're in a place like Seattle, Washington, you don't even know where you could go to find a property that only costs $185,000, right? Right? Okay, so it's your perception and your perspective. What I'm getting at is that $185,000 property, that's a great deal for somebody that's trying to get into the housing market as a new home buyer. In other words, not somebody that's buying a new home, but they're new to the home buying market. So they're buying resale property, and a $185,000 property is an entry-level price point. Do you really think that the entry-level price points are going to come down significantly? They might, they could, but the reality of it is this. There's a lot of cash sitting there on the sidelines looking for a house that's worth $185,000. Most houses in the entry-level market prices for people that want to consume their own home are well over $200,000. Yeah. So do you think that you're going to have a problem selling this house in the future? I would submit to you, you're probably not going to have much of a problem getting this asset sold. So what you need to look at is you need to look at buying the asset, controlling the asset, repairing the asset, putting the right people into the asset, operating the asset, making great cash-on-cash returns, hold the property for 1 year, 2 years, 3 years, 4 years, 5 years. Whatever your game plan says to hold it for that time period. And when it makes sense, when it's a part of your decision-making strategy, sell the asset or refinance the asset. Harvest the equity in the asset, and then take that equity that you've just harvested and go buy more assets with that equity. That's the beautiful thing about what I'm talking to you about. And because we've got, in this particular deal, we've got almost 100% equity capture. That is a huge, huge insurance program for you. Although you're not buying insurance to protect the equity. No, that doesn't exist out there. There is no marketplace for that. It doesn't exist out there that I'm aware of. But at the end of the day, do you see it? Do you see how you could take, let's just get into basic numbers. If you had $10,000 and you could turn it into $20,000 just by buying an asset, and that asset went down in value, say 27%, you still have 73% of that equity that you captured protecting you against that 27% decline. So even if you sold the asset at a reduced price, you're still taking an additional 73% of equity out of that property. Do you see how we could sell that property even in a declining market and we can make money on the asset? And then what do? Once we make the money with the asset, we go out and we buy more assets to replace it. If you sell one, I want you to go out and try and buy two to replace it. And if you can't buy two to replace it, don't sell the first one. Yeah, we're talking strategy now, because what I want you to do is I want you to double. Every time you sell an asset, I want you to double your asset count. Sell one, buy two. Sell two, buy four. Sell four, buy 8. Wow, that's a lot of properties, isn't it? But it's not hard to do. And once you're educated on how to do it correctly, man, the sky's the limit. And you can get yourself retired in the next 5 years. If you want to do what I'm doing, go to lifestylesunlimited.com, sign up for a free workshop, and let's get you going.
The information and opinions you hear on the Lifestyles Unlimited Real Estate Investor Radio Show are those of the hosts, guests, and callers. The Lifestyles Unlimited Real Estate Investor Radio Show is for entertainment purposes only. Please consult a professional regarding your personal investment needs. Nothing presented constitutes an endorsement, recommendation, offer, or solicitation to buy or sell any product or security.